In today's video, we're going to take you through some common first home buyer questions and answers,
including one tip that might help you increase your deposit for your first home. Let's dive right in.
So Dennis, we recently ran a webinar for some first home buyers and we had a great response. There are heaps of awesome questions asked. So we thought we'd go through some of the most common questions and the answers to them that these first home buyers had. So the first question, I have a pretty hefty HECS debt, like about $70,000. Will this have a significant effect on my borrowing power? And should I make voluntary repayments on top of the amount coming out or just let it ride out?
Yeah, this is a common question we get asked a lot. HECS debt definitely decreases your borrowing power. And the reason for that is the banks take it as an ongoing commitment, which is a percentage of your income. An example of this is if you're earning $100,000, the banks will calculate your repayments for your HECS debt at 7%, which is a government threshold for HECS repayments on 100 grand. Now, the fact that you've got a 70,000 HECS debt doesn't change that repayment commitment. It's purely based on your income. So if you've got a 10,000 HECS debt, a 30,000 HECS debt, or a 70,000 HECS debt, your repayments are exactly the same. So it can make sense to pay your HECS debt where the balances are lower. So in examples where you might only have 2,000 or 3,000, well, on 100,000 HECS debt at 7%, the banks are still calculating that commitment at $7,000 per annum. In that event where you've got a low balance, it absolutely makes sense to pay it off, and that will increase your borrowing power quite drastically.
So in short, it's not what you owe, it's what you earn that really determines your borrowing capacity and affects you when it comes to HECS debt.
The second question we had was around deposit. Can you withdraw from your super fund for your first home? Or does it have to solely come from your super saver scheme? Or do you need to put it in a super account?
Awesome question. So there's two things that you can do here. The first is the first home super saver scheme. So we've got a different video on this altogether that covers it in a bit more detail, but to be eligible for this scheme, you need to make additional contributions on top of the minimum that goes into your super account every month. So by law, your employer will put 9.5% of your pay into your super every month, and that just gets locked away and you can't access that for your deposit. But with the first home super saver scheme, you can make additional contributions to your super fund that gets kind of allocated away towards the super saver scheme, and then you can withdraw that out in the future to pay for your deposit. The downside to this scheme is that usually it's only worthwhile if you're looking at buying in sort of 6, 12, 18 months away. If you're looking at buying in the next month and trying to make contributions at the last minute, it takes about a month to kind of redeem the money and gin around, so it's generally not worth it in that circumstance. The second way that you can use your super funds to buy a property is within a self-managed super fund. Now, this was pretty popular a few years ago. It's not so much these days. The banks have pretty much gotten out of it. It's pretty difficult to do. So at the moment, as a first home buyer, the only way to access your super funds to use towards your deposit is through the first home super saver scheme. All right, now, so the third question we got asked is, if you're declined for a home loan, will there be a record of it? And will it possibly affect the likelihood of you being approved in the future?
The credit reporting agencies actually list every time you make an inquiry for finance. So for example, if you've done an application for a bank and you get knocked back, well, the knockback isn't listed. It's just the inquiry. However, when you apply for a new loan with a different bank, that bank might actually ask you what happened with that inquiry you had earlier. So something to be aware of, the inquiries aren't listed on your credit file to say you've got declined. However, when lenders do applications and are assessing your situation, they will ask what's happened.
Yeah, you're completely right, Nate. The other thing that the banks get a bit sus on is where you try to apply for too many things in one go. If, for example, you apply for an online pre-approval through Commonwealth Bank, St. George, ANZ, a bunch of different banks all in one day, that will show up as inquiries on your credit file. And the banks will be a bit more cautious when reviewing your application because they're going to assume, well, ANZ probably knocked you back, CBA weren't happy with it, and you come into St. George now, there's probably a problem here. So you just want to be careful with the amount of times you do apply for a home loan, especially within short periods. All right, we've got another really good question here, kind of in the current environment, it's pretty true. So the question is, if I'm stood down for my job, once I go back to work, will the bank still consider giving me a loan, or will they expect me to be back in my job for 6 months before applying?
Well, it all depends on your employment status. Once you've been stood down, there's no lenders in the market that would lend to you in that current state. As soon as you've found employment, lenders will be open to assisting you again. Now, there's a couple of different employment avenues that you might go down, so you've got to be careful of this. For example, if you're full-time or part-time, we'd only need really 1 or 2 pay slips and off we go. We can move forward with an application. If you are employed, casually speaking, lenders will want to see a bit more of a history. anywhere from 3 months onwards. So it depends on that employment, what type of employment you've secured, and that would actually dictate how long you need to wait.
Yeah, so pretty much if you're full-time or part-time, you just need a pay slip and you're away. Or if you're casual, you might need at least 3 months history to apply for a home loan. All right, Nate, so I've got another question. This one about building a home. So the question is, can you please tell me about buying land and building? Is it possible to buy the block of land first and not build for 3 to 6 months? Do you have to pay extra taxes up front or after you build a house?
Well, the short answer to that is yes, you can buy land and sit on it. Most lenders actually want to see you have an ability to do the construction. So you need to still be able to demonstrate your ability to borrow and your capacity, as well as potentially having deposit there. So that's the only thing. There usually isn't any restrictions on how long you can sit on the land for, but the banks do want you to have intent to build in the future.
Yeah, so we find this generally varies from lender to lender. There are some banks that say, hey, you have to start building at least within 2 years. We don't want you land banking there. There are others, like Nathan said, that are pretty flexible and kind of like, yeah, when you get to it is when you get to it. The most important thing, like Nate said, is around your income. So they're still going to be looking at, well, if you're buying a block of land, you're obviously not living there on a tent, so you're gonna have to still be paying rent. So can you afford to pay rent and afford the mortgage on the block of land at the same time? So that's the biggest difference. Whereas if you're sort of buying a house and land together, they say, well, the rent's gonna finish. You just need to make repayments on this and it's all sweet. And also to answer the second part of the question, you only pay stamp duty on the land value. So you're not paying it on the house value, and that's all paid up front when you settle on the block of land. All right, and so the last question, which is really relevant in 2020, is on the first home loan deposit scheme. So Nathan, with the first home loan deposit scheme, does the property have to be brand new to qualify for the scheme?
So a quick recap here. The first home loan deposit scheme is a government-backed guarantee, effectively waiving your mortgage insurance if you have less than a 20% deposit. So the answer to that question is no, the property doesn't need to be brand new. However, depending on the state you're in, there are purchase price restrictions. So as long as you're under that maximum purchase price, you'd be eligible to qualify for the first home loan deposit scheme.
Yeah, so in Brisbane, for example, it actually depends if you're a regional or metro. So in Brisbane City, in Brisbane metro area, it's 475,000. Sydney, it's 700,000 purchases. Melbourne, it's about $600,000 purchases. So it really comes down to that. It can be new, it can be old. You can even have a situation where if you bought a brand new property, say in Queensland, for $400,000, you could have the lender's mortgage insurance waived and you qualify for the $15,000 first homeowners grant. Pretty sweet.
So that's it today, guys. Thanks for joining us. If you liked today's video, please give us a thumbs up and subscribe. As always, thanks for watching.